internal processes to ensure that they have a level of consistency to compare themselves. So I think it's an afternoon where we will hear some good information on what it is, how it's applied, and more importantly, why it's so critical for the evolution of ESG reporting and ESG itself. So again, thank you for joining, and let's all enjoy the webinar. Adele, over.
Thank you very much, Kwame. And we are all hoping for an insightful session at the end of the day. So as Kwame said, please make sure you are interacting with us, ask your questions, bring your inputs, and then it will make the session very interactive. And before you leave here, you would have gotten a few things for you as an internal auditor, what you're supposed to do or what you're supposed to know regarding the implementation of IFRS S1 and S2 in your organization. So going forward, I would like to introduce you to our facilitators. And first on our list is Osei Asenso Enchi. Osei Asenso Enchi is a senior manager in the governance, risks, and compliance services with KPMG Ghana. He has over a decade experience and has delivered advisory services to a wide range of clients across different sectors, such as financial services, agriculture, health, and government institutions. He currently leads the ESG and sustainability service line at KPMG Ghana. He has served as subject matter expert and has led teams to deliver ESG transformation services, including ESG risk assessment and due diligence, ESG strategy, sustainable finance, and sustainability reporting. His work has resulted in business resilience, operational efficiency, access to funding, and impactful reporting for clients. And it will be good for us to note that Osei Asenso also holds a CIA. So for the internal audit focus session of the webinar, he will be giving us some good insights over there. Next is Yewande Adeyi. So Yewande Adeyi is also a senior manager with the Sustainability ESG Services, KPMG Nigeria. She has vast experience in broad range of sustainability-related services, which include sustainability strategy and reporting, baseline and socioeconomic impact assessment, sustainability assurance, capacity building, corporate governance framework, board and company secretary appraisal, amongst others. Her industry experience covers agriculture, FMCGs, DFI and commercial banks, energy, and oil and gas. So today we have Yewande and Osei Asenso to take us through this webinar. I'll firstly hand over to Yewande to begin the session. Thank you.
All right, thank you very much, and good afternoon, everyone. Thank you for joining this webinar. Maybe just to quickly check the room on your expectations for today's session. You can quickly drop that in the chat box so that we can be sure to align with your expectations. Thank you. Let's do that within 2 minutes. I'll be checking the chat box to see if we have comments there. Okay. So while we expect participants to drop expectation, to say that the overall objective, that we have in mind for this webinar is to be able to enhance the level of awareness, and especially among internal auditors, on the standards, the IFRS S1 and S2 standards. As you're aware, ESG is everybody's work. Yes, while there might be a dedicated desk for sustainability within an organization, it is everybody's role and everybody has a contribution to make. So it is also very important that internal audits are listening to this at this moment, and they're able to understand, have an overview of what the standards are, and then what their role will be in ensuring implementation within their organization. So moving on, to generally the concept of sustainability reporting. A typical sustainability report will contain environmental, social, economic, and governance performance and impact of an organization, meaning that the organization understands the exposure it has to economic, social, environmental, and governance factors, understands the risk, the opportunities, has a strategy around it, is monitoring and evaluating its performance over time, and the impacts, and is then able to come up with a report encompassing all of this. So which then goes to say that it goes beyond financial performance, really. It goes beyond the revenue. It goes beyond the profit that we record as a business. What it does is to measure that beyond that financial performance, what really drove this, at the expense of what did we achieve our financial performance? Is it at the expense of the environment? Is it at the expense of the people in the environment? That is what sustainability helps us, and sustainability reporting helps us to disclose. So typically it will include an organization's overview of the plan and strategy. So what metrics and targets they've set and how they're monitoring the performance, build narratives around that, both qualitative and quantitative, to be able to demonstrate corporate responsibility to the stakeholders. So sustainability reporting over the years has been guided by various frameworks and standards. The most popular being global reporting initiatives, the standards by the global reporting initiative. I think that it was reported to be the framework against which organizations reported mostly. And that's what almost everybody is used to. However, there are other major standards that some organizations still report to as well. We have the Sustainability Accounting Standards Board, the standard by SASB. This is quite a comprehensive standard that cuts across about 77 sectors. So some organizations actually make use of this, and sometimes they combine it with the GRI as well. So we also used to have the Task Force on Climate-Related Financial Disclosures, as the name implies, focusing a lot on climate-related matters and how they impact financial performance, And we also have here the International Integrated Reporting Council, that's the IR framework. What that does is to say that you don't have to have a separate sustainability report. You can, in a holistic manner, report your performance as an organization, both from financial and non-financial perspectives. There are several other frameworks as well, aside these, that organizations have reported in line with, depending on their jurisdiction as well. There are various local standards, that organizations need to comply with. There are also some standards and frameworks that organizations comply as a result of their own commitment or affiliation. So for instance, if I have decided that as a corporate body, I'm going to be a member of the UNGC, for instance, the United Nations Global Compact, it then means that I need to abide by the requirements of the UNGC, meaning that when I'm reporting as well, I need to report some criteria, my performance in line with some criteria to the UNGC as well. Even sectoral bodies as well, in the insurance sector, in the banking sector, manufacturing, there are quite a number of them that organizations do try to report in line with. So you can see a sustainability report that says that it is in line with about sometimes over 10 different reporting frameworks because the obligations are a lot. However, sustainability reporting may not be as smooth as it sounds. Organizations experience quite some challenges when they're embarking on sustainability reporting journey. And that is why they are not as common as financial reporting as you see out there. And what are the challenges they face? Number one is the strategy. So a lot of times I say that you cannot report what you have not executed. What exactly am I reporting in my sustainability report? That means I must have done something. What guided what I did as a corporate body, right? Strategy, a plan, a framework, or whatever it is that I have as an organization must have guided my reporting for me to have a comprehensive and holistic report. And that is why sometimes you see some sustainability reports. You look at them, they're quite large, but you are not able to make too much sense of them because there wasn't such a strategy behind it. So the organization is then reporting haphazardly, just reporting by chance. Also, stakeholder buying. If you don't have stakeholder buying to have a strategy, or you have a strategy, you don't have stakeholder buying to execute that strategy, reporting is definitely going to come struggling, because all the support you need is not there. And unfortunately, sustainability professionals are not able to work on their own because the data sits everywhere, the requirements sit everywhere. So it is important that the buy-in is there, even from co-process owners. So for instance, as an internal auditor, if you're going to include ESG metrics in your annual plan, for instance, it then means that you need some information from somebody like you typically will have, from for other areas of your work. So if leadership buying is not there for ESG, for instance, it's not likely you get the data the way you get data for risk management, for compliance, all of those areas that are quite more standardized than sustainability. Also, if the process owner you need the information to, if you don't have the person's buying as well, the person is considering it as an add-on work, like an extra work in addition to the regular KPI they have. So it's not likely that you can audit what they have. That's if they have at all. Also, access and integrity of data. So because some organizations may not have the structure they have, when it comes to other functions like finance, like risk management, like they have before. So the data may not be in a structured manner. It may not be as accessible. So if I'm not able to access data, what am I now reporting? Sometimes it's integrity of the data, the quality of the data. You are getting the same data from sources A and B within the same organization, and they are different. So how do I then develop a report from that? I need to first of all go back to the drawing board, get clarity on the discrepancies before I can proceed to reporting. Some organizations are not reporting today because they don't have comfort over the data they have. Not that they don't have data at all. Also, interoperability and transitioning. So now you say that we should integrate sustainability into the business. We have not even understood how the integration is going to happen. How do we then report in a cohesive manner that it is not separate from the business? Transitioning as well, a lot of these standards are coming now. They are coming up, and we are probably using some standards before. How do we bring all of this together and provide a single holistic report? Nowadays, when I look at some sustainability reports, I see the sustainability report as a house. You then see sustainability reports in line with XYZ, one section, pages 1 to 20. You see sustainability reports in line with this framework, pages 20 to 50. You see another, so you see segments, and then you still find the same information across each of these sub-reports of the house. So you are then wondering, what are we doing here? But it's due to that challenge of transitioning, that challenge of interoperability. That is why you are having that kind of situation. Also, with corporate governance, I always say that governance is the foundation for sustainability. If the governance is not right, it is not likely you get anything tangible out of the whole process. How then do you want to report? Nobody is holding anybody responsible, for different sustainability data that sits with them. How then are you able to get the data you need to develop a compelling report? It then becomes a challenge. So those are the challenges that some organizations have faced. But despite these challenges, you will see that the trend of sustainability reporting is still increasing. More organizations are reporting. And why is this? Despite these challenges, there are risks associated with sustainability, and there are risks associated with not managing your sustainability factors. And if they materialize, they still come back to impact your bottom line. Even if you decide that you are not going to seize the opportunities, you have to manage the risk, whether proactively or reactively. Secondly, regulatory requirements as well. Gone are the days where organizations are left to do their thing, whether they decide to report on sustainability performance or not. Now it's becoming mandatory. So for instance, the ISSB standard is now mandatory, in Nigeria, for instance. So we then need to start considering as organizations, how do we embark on our journey such that when the deadline is here, we are able to report. Cost savings as well. I've had a number of people tell me that, you want a lot of renewable energy initiatives, a lot of resource saving initiatives that some companies are embarking on. They are not necessarily to protect the environment or to protect the people. They are just because of their own reasons of needing to save costs. I say no problem. At least, in addition to saving costs, we have contributed to saving the environment, and we've also contributed to general preservation of the community as well, right? So that is to say that while we are doing all of these things, while we are managing our ESG risk, while we are harnessing the opportunities, and while we are managing the risk, we're also harnessing opportunities like cost savings and operational efficiency, global reputation and market access as well. If you look at the ISSB, for instance, it's a global standard. So it means that I'm going to be able to compare organizations based on that report. So your reputation, can be formed from just one person comparing two reports from different organizations. Market access as well, because of the unification, organizations or fund providers or investors are then beginning to look at all of these factors in giving their funds out, because they are understanding the risk and they want to see that as an organization, you are managing your risk well, and there is eventually a return on their investments when they reinvest in your business. And then talking of transparency and accountability, of course, because we're able to put our reports together, we are holding ourselves accountable. And in the course of putting it out there in the hands of stakeholders, we are demonstrating transparency. We are saying that this is what I am doing as a business. This is where I am in my sustainability journey. So these are the different drivers, that are pushing the sustainability reporting narrative and, enhancing the growth that we have out there. So then, speaking to the rise of sustainability reporting in the context of Ghana, in the context of Nigeria, I would hand over to Asenso here to, demonstrate to us, how sustainability reporting came to place in the context of the jurisdiction Ghana. Asenso.
Sure, Yewande. Thank you very much. And good afternoon to everybody on the call. Thank you for joining us. I think that right from what you've said and discussed before, yes, sustainability has really been part of us, and now the reporting, a lot of factors are driving why businesses have to report, which you have just discussed. in Ghana, we've seen the rise in terms of sustainability reporting from perspective of, let's say, we put it in 4 main quadrants. So the one is demand from stakeholders. Stakeholders across businesses, stakeholders in governance, stakeholders in the community, because we have advocates who want to see us be responsible businesses, responsible towards our environment, responsible towards the community. So we are seeing businesses wanting to understand what, as a business, what are you doing? And therefore, it's important that we report as a business what we are doing in terms of our environmental, social, and governance responsibility. We've also seen a rise in key government initiatives that have also, or that are driving the reporting. Key amongst that is Ghana has now developed its green taxonomy. So definitely labeling a lot of products, helping us to understand what is green and what is not green. With that clarity, now businesses are able to communicate that these initiatives that we are doing are really supporting the sustainability agenda and what not. Also, there's this country roadmap financing roadmap, which was also developed by the government, to also understand that as a country, where are we in terms of funding some of these SDGs or these commitments that we have made to international treaties and pacts. So that is also another part that is driving some sustainability reporting here in Ghana. The third one, which is related to government again, is regulatory directives. We've seen a number of directives come up across all the sectors, particularly in our financial sector. We've seen the likes of Bank of Ghana, the likes of SEC, Security and Exchange, the likes of Ghana Stock Exchange. All these regulators have come up with directives that are guidelines encouraging players within the industry to report. Currently, even the insurance industry has also come out with a guideline. So it is catching up with all the industries. We know that from the regulatory perspective also, EPA, Environmental Protection Agency, has currently updated its act, which has also highlighted some key requests or some key compliance requirements from businesses, especially even relating to plastics, since it's one area that government wants to also tackle. And then, of course, the last one being the adoption of IFRS S1 S2 by our Institute of Chartered Accountants, Ghana, that has the expectation that companies will report at a certain point in time. So, Yewande, these are some of the factors that have been driving the discussions and reporting here in Ghana. Thank you.
All right. Thank you very much, Asenso, for that overview in Ghana. Before I proceed to Nigeria, let me acknowledge the expectations that I see in the chat to learn how internal auditors can effectively support their organizations in complying with these new standards. Okay. Clear understanding of key compliance requirements under the IFRS S1 and S2, and the practical approaches to evaluating readiness, identifying control gaps, and aligning audit procedures with this new standard. All right, thank you very much for that. So once I conclude the overview on the IFRS, Asenso would also take the key parts, on what the roles of internal audit are. And I hope that you'll be able to achieve those objectives from that. Thank you very much. So speaking to Nigeria and what the trends have been, so I think the major start in Nigeria from jurisdictional perspective was when the Nigerian Sustainable Banking Principles came up in 2012, when banks in Nigeria had to comply with 9 sustainability principles that the CBN had put forward and required them to report on a periodic basis. And that is why you see that in Nigeria, quite a number of banks are reporting on sustainability and have quite advanced in it compared to some other industry. For some other industries, you will see CSR reports, you see HSC reports and all of that. But I think the banking sector had been quite advanced more than the rest because of this regulation. Also in 2017, the NGX collaborated with the Ministry of Finance and other stakeholders, such as Development Finance Institution, to launch the first climate change bond. So this also then drove the sustainability narratives within Nigeria. So if you are issuing a climate change bond, there are certain requirements you have to comply with, as to the use of the proceeds and all of that. And of course, you then need to report periodically on what the impacts are. Also, the 2018 Nigerian Code of Corporate Governance, which then brought the overview of sustainability matters, as a board issue. So the board needs to have oversight of sustainability matters within the organization, which means that something has to be done for there to be, oversight. Also in 2020, the Nigeria Economic Sustainability Plan came up, and it had requirements for organizations, for corporates to key into, and in the course of keying into, when you're also then reporting, you're also then saying how. Sorry, Adelaide, I think there is a background. Okay. Okay, thank you very much. So organizations, when they then report their sustainability performance, they're also able to report how they key into this, just like they will align their reports with the SDGs at the global level as well. Also in 2021, when Nigeria committed to net zero, to achieving net zero by 2060 at COP26, this then gave birth to the Nigerian Climate Change Act that then requires organizations to embark on climate-related journeys, and start making reports, including reporting on their emissions. And these binds organizations with 50 employees and above, which means that people need to commence their journey. Also, Nigeria was one of the first countries to launch the ISSB standard in 2023. I think the first in Africa. And so this also then put a bit of pressure on the corporates, since the country has onboarded it for corporates to start their journey. And in 2024, March, the FRC released the adoption readiness roadmap, for IFRS S1 and S2. And then there was a call for early adopters, to which 4 organizations responded, and they reported their 2023 in line with their 2023 performance in line with the standards. So going into the standards, what is this standard about? What is it based on? First of all, the standard recognizes that there are a lot of frameworks and standards out there, and what it did was to leverage to the extent possible some of these existing standards. So for instance, the TCFD more or less forms the foundation for the ISSB standards in terms of the framework, the structure, for reporting. The TCFD, when you look at it, it asks you to report climate performance in terms of governance, the strategy, the risk management, and the metrics and targets, that the organizations have set. So the ISSB also follows the structure, and which was why I said when the earlier I had said that the TCFD used to be in existence. So now the ISSB makes up for the TCFD, and organizations don't need to focus on the TCFD anymore, because when they adopt the IFRS S2, they will be in compliance with the TCFD recommendations already. Also, the ISSB leverages the SASB standard and also refers us to it, in determining our materiality, in determining our risk and opportunities, because it is sector focused, and that way you're able to streamline your focus, to what is related to your business. The ISSB standards also, you will hear they refer to the board as a sister board to the ISB, being that the ISSB board leverage, some concepts from audits from the ISB standards, looking at how we define materiality, looking at even other concepts like estimates, fair value, and other practical concepts generally. So the ISSB standard is not entirely new. It leverages existing frameworks to give us what we have today. So what are the objectives of these standards? First of all, is a global baseline standard. So there were several standards that organizations were reporting in line with. So now when you have the ISSB and everybody replies reports in line with the ISSB, what it then does is that it brings all of us to equal footing, and users of the information are able to compare an apple for an apple, not an apple for an orange, because we are, on the same baseline. Also, it is investor focused. There are several focuses that other standards have, but this focuses on the people that would actually rely on information of a typical financial statement, the credit providers, the investors, and all of those areas, people that need to make decision, as a result of the performance that we report on. Also, in terms of interoperability, one of the objectives of the ISSB is to facilitate interoperability, with jurisdiction requirements, with existing frameworks, to ensure that everything is cohesive and it's not another standalone requirement. And also in terms of proportionate approach as well. So when you look at the structure of the ISSB standard, the S1 and S2, they follow the structure of governance, strategy, risk management, and metrics and targets. So the S1 in this structure is the general requirements for disclosing sustainability-related financial information. The S2 similarly, but now focusing on a particular sustainability risk, which is the climate-related risk. So there are going to be other standards that are going to be topic specific as well, and will follow the same series over time. So the essence is that framework is already there. The framework of governance, risk management, strategy, metrics, and target is already there, and we just continue to layer the different topics on it over time. So these pillars, what are they about? Governance. There is hardly any concepts that can fly without the appropriate governance. And what is this governance? The processes, the controls, the structure, that the organization uses to monitor the sustainability-related risk and opportunities. Who is responsible for what? Who oversees what? What are the requirements? That structure that enables us to be able to monitor and evaluate performance over time. That's what the governance framework is about. The strategy as well. What approach are we adopting in managing this sustainability risk and opportunities, especially when we have identified the ones that are very significant to our organization and we need to start reporting in line, and the structure of the strategy can be across different time horizons, can be over the short, medium, and the long term, depending on how we have defined our horizon within some organizations. I've had organizations that their short time is between 0 to 6 months, and I've had those that have had 0 to 3 years as a short time frame, depending on what we have determined best for our business. Also, in terms of the risk management, which is the crux of the matter, saying that how do we identify, how do we manage, how do we, assess, how do we report this risk that we have identified as a business? Typical to enterprise risk management. Sustainability risk management is a very is quite an intensive exercise, because there are quite a lot of risks out there. You then want to identify which ones impact your business. After identifying, you want to assess and be able to prioritize after to say that, oh, these ones, when they materialize, this is the extent to which they would impact my business, or this is the likelihood that they will materialize in the first instance. And then looking at metrics and targets, what that does is just to bring measurability into the whole discussion. You have identified this risk. How do you then monitor them? You need to identify metrics across each of those risks, that you want to be monitoring and evaluating over time. And under those metrics, you still need to set targets as well. So if, for instance, one of your metrics is percentage ratio of male to female within the organization, for instance, you probably want to set targets to say that this is at the minimum at any point in time, one gender must represent 30% of my workforce. It's then important that you set that target so that you're able to track it over time. So, and like I said, additional standards are going to be built based on this framework of 4 pillars. So moving on to the specifics, what does the IFRS S1 contains? What is the objective? And what's the scope of the standard? The objective is to require an organization or an entity to disclose information about its sustainability risk and opportunities that is useful to the user of general purpose financial reports in making decisions relating to providing resources to the entity. So what it means is that these same stakeholders that we provide our financial reports to, that they look at this and they want to know if they should continue to invest in us. They want to know if they should continue to make those loans available to us. They want to know if they should continue to do businesses with us. These same people, is then requiring us to disclose information on sustainability related to them in the manner in which they are going to impact the financial prospects of our business. So in terms of requirements as well, it goes on to require us that we disclose all the sustainability related risks that could reasonably be expected to affect the entity's cash flow. And that is where the concept of materiality comes in, reasonably expected to affect. So it means that there could be a risk, but it's not so material to us as a business, and the impact on our future cash flow may not necessarily be significant. So in that situation, for instance, the standard does not require us to report that particular risk. But once we know that this risk is going to affect our cash flow, is going to affect our access to finance, is going to affect the cost of capital, over the time horizons, then it is important that we report this sustainability risk. And it refers us to the SASB, for us to guide us in identifying this risk and opportunities. And then what's the scope? The scope covers, that we report in line with the standard, and where we have not complied with all the requirements of the standard, we cannot report and say that we have complied. Also, it is entity specific. So if, for instance, I am reporting group for my financial performance, for instance, I cannot then report sustainability focused on an entity, or if my financial statement is focused on an entity, my sustainability, my sustainability report has to be within the same scope. It cannot be at group level at that point. So if you look at as I said, the IFRS S2 as well, the S2 also follows the same principle, just that this time around it is risk specific. And what is the risk we are talking about? The climate risk. That's the difference between IFRS S1 and S2. The S1 sets the foundation for every other standards, that will be released, whereas the S2 is one of those several standards that then focuses on a specific risk. So in the same light, it requires an organization to disclose material information about climate-related risk and opportunities to meet the investors' information. And what is it talking about? It's talking about both the physical climate risk and the transition climate. What are physical risks? These are risks that, like the name implies, physical. The impact on our organization is physical. We can see it. So for instance, when you talk of floods, when you talk of droughts, those are physical risks. You can see the physical impact. But when you talk of transition risks, they are not tangible like the physical risk. They result because of changes that are being adopted as a result of climate change. So for instance, when there is a policy risk, for instance, a policy change, for instance, as a result of climate risk, that then impacts my business, even though I may not be directly impacted by a flood or a drought, but because that policy is there, I'm then exposed to that. Even when it comes to machineries, for instance, or equipment, let's take cars, for instance, as an example. Some cars are being banned in some countries, because of the emissions, the level of emissions they contribute to the environment. So for organizations that are not able to upgrade their fleets, for instance, they are exposed to transition risk. If they are not able to upgrade to the newer models or to electric vehicle or CNG driven vehicles, they are exposed to transition risk, and they might likely be caught up in that. So the requirement of IFRS S2 is that we report all of this, as the impact our business. Also, I spoke about the ISSB being a sister board to the IASB, because it's leveraged some principles of audits that we are used to, either as external auditors or internal auditors. First is the fair representation principle. It requires the disclosure of the relevant information about the sustainability risk and opportunities that could be reasonably expected to affect the entity's prospects, in accordance with the principles set out in the standard, and ensuring that they are faithfully represented. And what do we mean faithfully represented? First of all, they must be verifiable. If a third party comes to evaluate, what we have reported, our performance, they should be able to arrive at the same results that we are disclosing. It must be timely as well. Sometimes you will see some organizations reporting 2023 performance in 2025, right? And that 2023 performance is meant to impact my judgment on how I want to deal with you as a business in 2024. So which means that in 2024, I was blinded and my decision was not informed. So that's where the principle of timeliness comes in. Understandable as well. It must be clear and concise. Some sustainability reports can be complex, because they are trying to achieve various reporting requirements, probably because there is no strategy, probably because the person reporting does not even understand the full scope of sustainability yet. That understandability is very important. Comparability as well. I must be able to compare your performance with other people without sweating. Faithful representation, complete neutral. You're not trying to bias my thoughts with the way you have crafted. There's a way we can choose our words that is not here, is not there, or the reader is conceiving something else, whereas we meant something else entirely. So for instance, we want to talk about diversity. Maybe the component of the diversity we are talking about is just gender diversity, but there's a lot of components to diversity. There is a race, and there is all of that. So the reader of my information is looking at diversity in a holistic manner, whereas the diversity I'm talking about is just gender diversity. Relevance as well. It's very important that the information I'm providing is relevant out there. There are sometimes that it's possible to mix relevant and not too relevant information together, such that it then makes it difficult for the user of the information to extract the facts that they need, from that. Connected information as well. A lot of times you see within organizations, you see ESG risk register is separate from enterprise risk register. You see sustainability strategy is separate from corporate, all of those things. Yeah, while at the initial journey, it may be okay to have all of them, but as we begin to grow as a business, we need to integrate all of this such that the information is connected and we are reporting in a holistic manner. Also talking of even the requirements of the standards, there are 4 pillars: governance, strategy, risk management, metrics, and target. It has to be integrated as well. They should not be disjointed, because governance over what is still governance over risk and sustainability, risk and opportunity. Strategy on what? Is this strategy on sustainability, risk and opportunities? Even the metrics and targets that we are setting is still over sustainability, risk and opportunities that we have put together. So there has to be that synergy, in terms of the information we are providing, such that they are connected. So even when we then have the sustainability reports in maybe a holistic report that we refer to as an annual report, right, is not standalone. It's still important that all of those information is connected. We're able to connect the effects of the sustainability risk and opportunities that we have identified, the effect on the performance, the financial performance that we are disclosing, or the other hand, there has to be that synergy in the reports that we are providing. Also, in terms of structure, some people will tell you it has to be a section within a section in an annual report. Some will tell you it has to be embedded all together. Even the sustainability report itself, you will see some people reporting governance, strategy, risk management, metrics as separate pillars, whereas you also see some other reports where they report by their material topic. And under each of the material topic, you will understand the governance around it, you understand the approach to managing that particular topic, how they have managed the risk, and what targets did they set under each metrics, and what their performance is, what the outlook is, and they're reporting topic by topic. But what is important is that the information is communicating what the user of that information needs to see, needs to hear, and they're able to make informed decision about that. Our time is fast spent. I'll just quickly go through the roadmap for Nigeria and then hand over to Asenso, who takes us through the roadmap for Ghana, and then it continues with the internal audit rule. So speaking about the roadmap for Nigeria, so the Federal Reporting Council of Nigeria constituted a body that was referred to as the Adoption Readiness Working Group. So this group, of which KPMG Nigeria was a member of that group, came together with, and they came up with a roadmap, on how the standards should be adopted in Nigeria. It was phased into 4 groups, with the phase 1 being the early adopters, the entities that reported for the year ended 31st December 2023. There were 4 entities that did that, 2 in the financial sector, 1 in the telecommunications, and 1 in the energy and natural resources sector. Also, for phase 2, where we are now, 2024 to 2027, there are upcoming organizations, that are reporting in line with those standards, and we will soon begin to see the reports from those organizations. While some are waiting with the 3rd phase, which is for the year ending 2028, the public interest entities. And of course, the FRC also then released what qualifies an organization to be a public interest entity. And the SMEs, because of the nature of the business, is still growing. They have till 2030, to start reporting. And the government and government organizations, that is to be determined due to some work that is being done within those organizations at the moment. So I'll just pause here and let Asenso take the roadmap for Ghana, and while he continues with the rest of the presentation. Thank you. Back to you, Asenso.
Great. Thank you very much, Iwande, for that insight shared. Indeed, for Ghana as well, as I mentioned earlier, right from adaptation, right from the adoption, Ghana also moved to adopt the standard, and the ICAG, which is our regulatory body for this phase, for accounting in Ghana, decided to go through this in 3 phases. The first phase was a voluntary phase where it invited companies that were willing and ready to report to voluntarily report, and that time was given as at right from 2024 as the standard became effective that you could report. Given that it was expected that if you wanted to report, you'd have issued some readiness assessment to demonstrate that indeed you are ready to report. Moving on from the voluntary phase, now the period that ICAG has elected is that come 2027, all businesses or most businesses, as expected, have to put out their sustainability reports, and they put it in some categories, 3 main categories. One is the significant public interest entities, where this category covers all listed entities, regulated, non-listed entities. I mean, almost all entities, public companies, so the likes of banks, the likes of insurance companies, and some of these heavy industries in terms of our oil and gas companies, mining, manufacturers of cement and all of that. All those entities are expected that by 2027, we would adopt and report accordingly. The next phase is also, or the next group is looking at the other mandatory adopters, which are companies with some specific thresholds to look at adopting. The third phase, which is also another big sector within our economy, is the government phase. But for government phase, ICG has elected that because most of our government institutions report with the IFRS. IFRS, we know currently is developing its own sustainability. So ICG has taken that wait and see approach to say that let's wait for that body to also come out with its sustainability, and then we can force our government institutions to also report accordingly. So as you can see, it's just a matter of time. This will catch up with all of us, regardless of the business that you are in, whether in the private sector or the public sector. And therefore, it's important that as internal auditors or as accountants, finance professionals, we get ready for it, because it's just a matter of time. We will be up for reporting. The next segment is looking at, so for us as internal audits, as Adele mentioned in the introduction point, that we want to arm our internal auditors to play a big role in this, because indeed we do have a big role to play in this whole ESG reporting. What is the role that we are expected to play? I mean, it starts right from the definition of what internal auditing actually is. If you look at the Global Internal Audit Standards that was issued 2024, there are some key components in there that puts or that defines the expectations of internal auditors across sectors and businesses. That as internal auditing is an independent objective assurance and consulting activity, setting right from the onset what is expected of us. As internal auditors, we are expected to play two key main roles. One, provide assurance for our businesses, and then also do assurance, and then also do advisory for our business. The other key parts within the definition that I want us to remember is also the point about value creation. I mean, what is value? One day has taken us through the point that ESG is not, I mean, there's so much essence, there's so much relevance, there's so much value that, you know, can be derived if we are doing it right. And therefore, as internal auditors, this position us right from our definition of what we are and what's expected of us to be able to support the business to create value, leveraging on this ESG sustainability reporting for the business. So why should internal auditors be involved? I think we have explained that in the definition to say that, one, as an internal auditor, I mean, most of our internal audit engagements, and as we've engaged businesses or engaged people that are in this function, because of the position that you hold in the organization, think of it, internal auditor is able to interact with every and almost all the functions, all the processes that are in the business, and therefore it gives us that support. It gives us that opportunity to be able to support this whole ESG agenda. Another point is about the expertise. I mean, as a good internal auditor, one of the expertise looking at our competency framework is to be able to build strong business acumen, because as you go to audit treasury, as you go to audit compliance, as you go to audit ESG, as you go to audit governance, you need to understand this. So internal auditors have that broad expertise that it's very critical, or that can really help drive home this whole point of ESG, and therefore requires internal audits to be involved in this sustainability journey and reporting for the business. And then also the last point around most internal audit functions or internal auditors are expected to be independent. If you look at how most organizations are structured, they have access to board committees, access to, CEO access to all of that. And therefore, we believe that with their involvement in this ESG, they can serve as advocates and help to even escalate some of these topical issues and be able to drive home the point and help business to go on this journey. So it's important that as internal auditors, we get involved in this process to be able to help the business achieve what it intends to achieve. In what ways can we, or in what ways, what the role that internal auditor can play in this whole journey? We look at it in three main ways. One, as an assurance provider, again, drawing from our definition of internal audit. And I think this is the traditional role that most internal audits play, that we provide assurance to businesses on some of these key processes, key programs, and key initiatives that businesses are taking. And therefore, again, when it comes to ESG, we need to help the business. We need to provide that independent assurance that, okay, as a business, this is what we set to do. As a business, this is the strategy that we put in place. Have you been able to achieve it? Have you been able to, make some progress even on it? When it comes to sustainability, one of the biggest risks that we face in there is greenwashing, where businesses are not being truthful in terms of the progress they have made and some of the things that they are doing. As an internal auditor, this is one of your key responsibilities, that you are providing assurance that the narrative that a business is putting out there regarding its ESG performance or its ESG ambitions, truly it is accurate and it reflects the intentions and the ambitions of the business. Another role that we expect the internal auditor to play is also to be a trainer and educator. Again, drawing from our definition, we need to support businesses to create and sustain value. One of them, as we are discussing on this call, is about ESG and giving your understanding and giving your understanding of the control environment, giving your understanding of the people, giving your understanding of the business in general. We believe that internal audits are positioned to be able to communicate value to other functions or the people, the employees within the business, to really understand that this concept or this journey that the business is embarking on is intended to create this value and be that advocate that we expect you to be. The third one, definitely not the least, is also the advisory partner. Again, drawing from our expectation in our definition of internal auditors, that we need to be an advisory partner to our business. How are we leveraging on all the knowledge that we have of the business to advise the business in terms of, so you wanted to go through the four main reporting buckets on right from governance, strategy, risk management, metrics, and targets. With your understanding, having done this internal audits for a number of years, with your understanding of the business, with your understanding of the processes, we stand in a better position to be an advisory partner when the business is embarking on this journey, so that we help the business shape the right agenda. We help the business put in the things that really reflect the status and then the ambition of the business, right? So just to zoom in on some of the key functions or key roles that businesses can perform when it comes to these three functions that we've mentioned, that is the assurance provider, the training or educator, and then also the advisory role. Starting from the assurance provider, given our understanding, it's expected that internal auditors will start to incorporate ESG into their operational audits. So right from the beginning of the year, as we are doing our risk assessments, as we are doing our audit planning, as we are getting approvals for all of that, we need to begin to consider incorporating some of these ESG operational audits. So A1D has taken us through a lot, but you need to sit back and break it down into some of these segments and know which of them affect which operations, for which reason you need to include that in your report. So for instance, governance. If we are to do a poll on here on this call, how many times that even as an internal auditor, you audited your governance process? I'll be surprised to see the results, but from some of the literature that has been put out, not many of us do that. But now, given that governance is a key component in our sustainability report, I think it's high time that internal auditors consider some of these things and include that in our operational audit. So right from the planning, it's expected that internal auditor, you help advise your business to have this as part of your audit plan for the year. And not just have it as part of your audit plans. Again, we've seen a number of, through our engagements with businesses and clients, that some companies or some internal auditors are not able to even complete the audits. I mean, they would have a beautiful audit plan, internal audit plan. But then when you look at how many of these audits have been executed, I mean, very, very far off. That is not right, and it's not expected of us here. So as we are learning about this ESG and sustainability reporting, the expectation is that we incorporate it into the plans and actually go ahead to execute and perform these audits. Because as the, again, Iwande mentioned in the earlier part, regulations are changing. And because of the fact of materiality, things that were, high importance to business, sometimes change when businesses are responding to, the changes in the business landscape. So it's important that you are also able to follow this and then track it and revise your audit plans as and when necessary, and then really perform these audits to give the business that confidence or that assurance that the ambition that they have set to realize when it comes to ESG is still in progress, and they can achieve that. One big thing is also assessing the ESG programs. Again, businesses will go about to, right from their assessments, set an ambition. From that ambition, they will define a materiality that will tell them that, okay, based on this ambition, these are the things that you need to do to be able to realize that ambition. As an internal auditor, based on your expertise, your understanding of the business, your understanding of risk and all of that, is the business really going to achieve this? Is this program that the business, the program that the business intends to take, will it help them to achieve that objective? So we need to be able to connect all these dots so that businesses are not doing initiatives that are, far off from the ambition or the strategy that they set. It's one area that we've seen for most businesses. They would have one ambition, however, the initiatives that they are doing, it's not really, it doesn't support the realization of that ambition. And it's expected as an internal auditor, you go in to review these programs periodically, and then give that assurance to the business that indeed this initiative that we set, the impact of it, we are realizing it, and it's helping us to achieve the objectives that we have. The next one is reviewing the reporting metrics and disclosures. So now when it comes to reports, I know that for internal audits, we do very, very well when it comes to our review of financial reports. Now there's this whole concept of internal controls over financial statements. Related to that is also internal controls over sustainability reports, so that we can be sure that the narrative that the business is putting out, one, is right, and two, is communicating the right impact that we expect our stakeholders, and especially in this case of IFRS, our investors, to note and then also come through for us. So we need to constantly understand, one, what are the metrics that even the business has set? Are these metrics right? We need to give that assurance to our business. Beyond getting the metrics right, the targets that they have set against these metrics, one, is it even realistic? So Iwande cited an example of when you have, let's say, a material topic like diversity, and you want to balance the number of, males and then females on your board or even in the company. You need to go into give that assurance that, okay, for this metric, for this target that we have set year on year, this is how we are doing. Maybe year one, we've been able to realize that. Year two, we've achieved that. And therefore give the company or the business that assurance that indeed we are on track to meeting the metrics and disclosures that we have set for ourselves. And then the last, but not the least, is also support the external auditor. I know that as part of the transition release for IFRS S1 S2, assurance will definitely come in at a point, not now that you are beginning the journey, maybe in your first year or not, but eventually, since this is going to be part of our annual reports that we are issuing to the markets, annual report that we are issuing to our stakeholders, definitely assurance will come in at a point. We need, as an internal auditor, to be able to do some of these work so that when external audits, when they come over, they're able to rely on some of the things that you are doing. One, again, helping to save time, helping to save cost, and then also helping the business to do the right thing at the right time, not to wait till the last end where we meet the external auditors for them to let us know what we are doing right and what we are not doing right. So these are some of the assurance responsibilities that fall on us as an internal audit to be able to help the business achieve what it's set to do. One, make sure that it's part of your plan. Number two, beyond your plan, execute the audits. Define specific audits that targets, the data integrity, the source of the data, the strategy that we set, and is it correct, and all of that. Assess the programs, continuously assess the programs, because we have a lot of instances where businesses, the programs that they have set is way off. It's important that you are giving assurance that even the cost versus the benefits that will be coming to the company. So now you see a number of businesses going into solar. Vis-a-vis your business model, is it the right initiative to take, in as much as you want to support our energy transition program and also contribute to the environment? So internal auditors, we have a great task in this space, and we are trusting that we will do that to create value for the businesses that we work with. Now, the next section is looking at also, as an advisor, what is expected of us. I think we have discussed the first point around awareness creation. We need to understand this whole concept of ESG and help the business to transition to adopt it. Because sustainability reports, as Yewande mentioned in the first segment, you just cannot wake up in 2027 or 2026 or 2028, whatever point in time that you're reporting to report, when you have not done anything. And it's on us as business advisors, as business partners to our various companies, to create that awareness, to help businesses to understand the importance of these concepts, to help businesses to understand what they need to do to be able to get things right, to be able to integrate this concept into the business so that come the reporting period, we are ready indeed to demonstrate to the world what impact and how responsible we have been in terms of our environment, our social, and our governance initiatives. The next one is also to advise on ESG control environment. Super important, again, referencing the points that Yewande made about the fact that the governance is at the heart of this whole point of ESG. If we miss that part, everything falls apart. As it is said that what gets measured gets done. It's important that we are setting the right control environments, because if you don't have your board accepting this concept, trust me, it will be difficult you can get the chief sustainability officer, you can update people's terms of reference and all of that, because it's not checked, because it's not monitored, people will not do the right thing. So as an internal auditor, as we go engage in our businesses, as we go advising on our businesses, it's important, very crucial that we advise our businesses on the ESG control environment, such that we are helping our businesses to stay in line with, one, regulatory expectations, two, with our stakeholder expectations, and all other expectations that they have of us. So our control environment is super important. And as an internal auditor, we have to help our businesses to make and get that piece right, so that the other piece, I believe, will be consolidated on the foundation of our right governance. And then also recommend best practices. So internal auditor, one, you're expected to provide insights, and not just insights. Now we're even talking about foresight. Now we see a lot of changes in our regulatory landscape. Last year, there were a number of regulations that came up from EU that were going to affect a number of businesses here, especially those in the manufacturing sector. There are a number of regulations that are there that affect our businesses. how are we helping our businesses to know these things and be able to, be ready to adopt or be compliant to some of these things. There are best practices that some businesses are doing. As an internal auditor, you need to, come up to the point that you are providing these insights to your business and advising them that, okay, for this ambition that we have on our ESG journey, this and that are what we can do to be able to realize those ambitions. And businesses are trusting us to do that because we are expected to be a trusted advisor for our business. So we need to be able to do this and then recommend some of these best practices to businesses. And then also to also advise and advocate on ESG governance. I think this is again emphasizing the point that we have made about governance. And it's not just governance. We've spoken about the strategy. You and they spoke about the risk management. That's another crucial point because once you have an ambition, once you have a strategy, once you have an objective, you are definitely exposed to some of these risks. The risks that you may not achieve these objectives or these strategies. And as risk-based internal auditors that we are supposed to be, we need to guide our business to set and deploy the right controls such that we're able to achieve that. And then also not just risk management, but also the oversight of it. As in, do we have the right governance in place? Do we have the right policies even to drive consistency so that people are not, some of the issues that we have with our clients when we go in to assess some of these integration initiatives is that you have different functions doing different things. So HR is doing something that is driving the people or the social agenda. Procurement is also doing something around sustainable procurement and all of that. It's all over. But we expect that as an internal auditor, given the fact that you engage and relate to all these functions, given that you have these stakeholders that you are in touch with, you help advise and advocate for some of these things to get it right. So it's important, again, just to emphasize that one of our roles as internal auditor is to be a trusted advisor to our business. And therefore, in that role, one, we need to help create awareness around this ESG for the business. Number two, we need to help and build a robust control environment such that these ambitions or this agenda that we are on or this journey that we are on will be able to thrive. And then also advise on some of the best practices based on your learnings, based on your relationship, based on your understanding of the business, what will be the right practice for business to be able to achieve that ambition they have when it comes to sustainability. This slide is talking about the fact that at what point should we be involved? I am believing that from all the talking and all the discussions that we've had, you know that you need to be involved right from the beginning. As an internal auditor now, I think we've transitioned to risk-based internal audit. So you need to understand that you don't wait for the business to do all of that and then now they present a report and you now go and sit. You would have missed an opportunity for the business to create value, which is our key objective. And that is what we don't want to have. So as a business or as an internal auditor, it's right that you be part of this journey. You need to travel that ESG journey with your business as an advisor and then as an assurance provider. Of course, managing your independence risk. I know that's one question that we always get when we engage our clients on how to marry between being an advisor and then also being an assurance provider. But it's important that you are with the business as they go through this, from the governance and the strategy definition stage through to scoping the programs that you have to do, through to the risk management that you need to put in place, your policies and your controls, your tech and data. This could be another big pain point for businesses, that when you are ready to report and you don't have data, just imagine you want to put out your financial statements and you don't have vouchers, you don't have your assets registered, you don't have your bank account statements. You can imagine how crazy that would be. It's important that as we support business to integrate and operationalize this whole ESG concept, the technology solutions that we are going to deploy to support the business, as well as the data and the responsible parties for these data are identified and are guided through so that we have the right and accurate position to disclose in our sustainability reporting. Monitoring, we have talked about it, as well as oversight to see that make sure your governance is right. Make sure your governance is right. We cannot overemphasize this point, but it's important because if you miss that, then truly you have missed the point. So as an internal auditor, one, we are calling on you to say that this is part of your job description. Once you put yourself out and up as an internal auditor and you are guided by our internal audit definition, you have to be an assurance provider and you have to be an advisor. There are ways that you can provide that assurance we discussed. There are ways that you can be that advisor helping the business to travel the journey. So, I mean, what is next for us after hearing Yewande, hearing myself? The next action points that we are calling on you to do is to get acquainted, get to know about this whole ESG. It's not something new. Businesses are doing these things already. Keep learning, keep apprising yourself with some of these current and emerging standards, regulations, and frameworks because they will keep changing based on the industry that you are in. Continue to engage your organization. Remember, you are a business partner. Remember, you are an advisor. So that continuous engagement, remember, you are an educator as well. So you need to have those continuous engagements with your business just to tune their minds to this value level and help them to really go on this journey. As a business, as an internal auditor, you need to help your business, one, understand their current position, create or craft a very good sustainability roadmap, and then also make sure that the data, all the things that are required of you, you have it ready. I mean, the quality of data. From the press release by ICAG, it's expected that once we are issuing the sustainability report, you have your director, 2 directors, and then also the person charged with responsibility of this whole ESG concept signing on it. So it's a big deal, and you cannot afford to, one, greenwash and then also put out things that are not right about your business. And the last part is also to consult. I mean, as an internal auditor, you are definitely not alone. You never walk alone. And therefore, when you are challenged, when you know that some of the things can get very technical when we are talking about, GHG emissions, we are talking about some of these science and all of that. Get or engage your business to understand the need to get some of these consultants. I mean, some consultants, and definitely we are ready to support you to help you to be able to do the right thing for your business. And then also look out to getting some assurance on the things that you are putting forward. At least from now to 2027, we have about 2 years to put our house in order. So it's important that we consult and get the things sorted so that once we hit the mandatory period of reporting, at least for Ghana, and then for the years that have been set by Nigeria, we'll all be good to go. So Yewande will wrap up with this session based on the experience that they have had. They have been, they've adopted this, they adopted this earlier. So she will share some practical perspective for us as we wrap up on this session. Thank you very much. Yewande, over.
All right, thank you so much, Asenso, for bringing that internal audit bit up to life. Of course, I'm not an internal auditor, so you've done justice to that. So yes, what's the way forward? And I think it's quite clear from the conversations we've been having, is to first assess where we are as an organization vis-a-vis what the standard and the various requirements, the local requirements, what they demand of us. After we have identified that gap, we then need to design a plan on how to bridge the gap, as to what we want to do over the short, medium, and long term. After which we begin to operationalize, integrating into the various functions that are applicable. And part of the operationalization is then the audit, the internal audit across all of these functions, as it pertains to sustainability. And of course, start measuring and reporting. Yes, as internal auditors as well, we are then providing assurance, though internal, but, objective assurance over the data that is being reported over time. Yes, like you said, Nigerian companies have quite started their implementation journey, and based on the requirements of the FRC of Nigeria, basically this screen shows the readiness test that is being conducted for each organization. First of all, 3 months before the reporting date, which means that my reporting date is 31st December 2024, for instance. So by September 2024, I need to present a board resolution to the FRC, to demonstrate that I have the backing of my board to progress on this journey as management. Also, then there need to be a comprehensive gap assessment of where the organization is compared to where it is meant to be based on the requirements of the standards. Some organizations do this internally, some do externally, but that third-party eye is always very helpful to help you see beyond what you can see, being part of that environment already, and then developing the implementation plan. Not more than 3 months after the beginning of the reporting date, the organization is expected to submit sustainability disclosure procedure policies that have been instituted within the organization, evidence of the board approval of that policy, identification of transitional reliefs, because I think one part of the IFRS I didn't mention is also the provision of relief, because there is that acknowledging that we are moving from point A to point B. Some reliefs were introduced, to help organizations to transition effectively. Some of those reliefs, for instance, include climate first reporting, to say that, okay, even if you are not able to report across the various sustainability risks at the moment, you can focus on climate initially and then grow over time. Also, in terms of emissions as well, there is transition relief, to say that, okay, in the first year you can report your scope 1, scope 2, because we know that scope 3, a lot of those information are outside of you rely on information outside your organization to determine your scope 3 emission. You can also apply that relief to say that you will not be reporting on scope 3 emissions in the following year, with the first year, and then subsequently you do assurance as well. There is transition relief when it comes to assurance. So an organization needs to identify which transition relief they are going to apply. Also demonstrating that the enterprise risk management framework has already embedded a sustainability framework, evidence of board approval for that, even evidence of training, for board members, because they need to understand what they want to oversee. And then after the beginning of the reporting date, 6 months later, there is also need to show evidence of registration, of the professional body that you have engaged to support you in this journey, the models that you have adopted, the scenario analysis, and all of those, and so on and so forth. So once you are able to pass this litmus test, then you're able to proceed to other things and publish reports. And in Nigeria, I think I heard that an organization was fined for going publicly to say that they have adopted without meeting with all of these requirements of the FRC. So we had the webinar in April in Nigeria, where we brought in different organizations that are in different phases of adoption. We had organizations that had adopted and reported. We had one that had the reporting in progress. We had one that is just embarking on that journey. And, they gave different insights from that webinar, and I thought to bring some of what they said here. One of the speakers said that the choice is clear to embrace IFRS S1 and S2 because it's now a regulation, but we can go beyond regulation and acknowledge that it is a strategic enabler for us, or we risk falling behind in the rapidly evolving global landscape. Another speaker also said that organizations that are just commencing their implementation journey should begin with a clear roadmap, build internal capacity, achieve early wins, and gradually deepen the quality and scope of their decision. This demonstrates that sustainability is a journey, and everybody is at different points of this journey, and everybody can also decide their pace, as the journey progresses. We are not all going to have the same pace, but what is important is that year on year, we're able to report remarkable progress, towards our ambition as a business. Another speaker also said that they ensure that their customers are aligned with their sustainability vision, and that they achieve this through the various sustainability programs for potential borrowers, to leverage the bank's influence in promoting ESG practices within the ecosystem, meaning that they have an ESG checklist. They probably also have an exclusion list to say that we are not going to be running businesses with this kind of organizations that are not demonstrating responsibility based on our criteria. Another also said that that the standards is going to enable them to leverage opportunities for risk identification and management, implement top-bottom governance, benchmark sustainability efforts with peers, and drive energy transition solutions and respond actively. Another also said that value creation will be at the center of the organization's decision making, and that was even from a regulator saying that most of the time short-termism hinders this approach. There are various comments that came up, and we published that on the LinkedIn. You can always look at it. Overall, some people have embarked on this journey, and we can learn from them, from the various reports that are published out there. But I typically tell people that the first point of embarking on this journey is, first of all, reading the standards. There is no how we are going to implement a standard without knowing the content. A lot of times standards are housed, we just skim through. If we skim through, we are not going to be able to identify as internal auditors what specifically we need to be assessing, to safeguard the organizations that we work for. So it's important that we read and understand this standards to position ourselves, to be able to provide both that assurance and advisory support to the businesses we support. So I'll hand back to Asenso or Adelaide for question and answer session. Thank you very much. Is anyone speaking?
All right, thank you so much to both presenters. We've been really educated about the IFRS S1 and S2, and I'm sure that if you did not have a clue about what you're supposed to do as an internal auditor, at the end of this webinar, you have an idea of what you're supposed to do, how you're supposed to start. And like Asenso said, if you do not know how to go about it, consult. And it's very important that you get yourself acquainted. That's a call for action, but you need to also consult where you realize that you do not have much information or data to go about your role as an internal auditor. So I would want to appreciate our facilitators. However, we have a few minutes to take in some questions. So if you have a question, you can either raise up your hand or you put your questions in the chat area. I see a few questions here, though there's been a response to it by you, and they also want to read that for all of us, since some of us may not have visited the chat yet. So we have a question from Janet. She's asking, given that companies are required to disclose sustainability risks only based on whether the risk is material and will impact their cash flow, will that not make some companies consider risks not as material and end up not disclosing? Is there no benchmark or threshold or reasonability test so all companies can follow? How then can we ensure some companies are not shielding some risks? And there's a response from Yewande, but after reading that, I would ask Asenso if he would want to add to that. the response from Yewande said that the standards give comprehensive guidance to assist in assessing what risk opportunity is material. Considering that one of the objectives of the standards is comparability, stakeholders can compare sustainability performance, and where there is a topic that peers have discussed but an organization has avoided, the organization will need to respond to queries from these stakeholders. So I'll ask if a person would want to add up to this response.
All right, sure. Thank you very much, Adele. And I think that's an apt response from Yewande on this. I mean, what I would add is that it's important. I mean, the key part of our reports, when you pick any sustainability reports that investors will try to look at or will definitely look at before they go into the details for your reports, is your materiality, so that they know that you are already or you are starting from the right position and not just reporting for reporting's sake. So that's what the SASB, as Yewande mentioned, is there for us to guide us, because some of these things have already been determined based on industry. So it helps to guide businesses that even if you are making a start, you can reference some of these framework to give you some understanding of at least what the general expectations are for you. And then you can, on top of that, add your peculiarity by the materiality assessment that you conduct. So I agree with Yewande on that point. Thank you, Janet, for that question.
Thank you so much, Asenso, for that response. Yewande also added that fund providers also have an expectation of what sustainability risk exposure an organization has. And she said that they do their homework because they want their investments returned. Hence, an organization may be shooting itself in the leg to avoid such topics. Yewande, please, you can go ahead.
Yes, thank you very much for that. I wanted to emphasize on that second point as well. So for instance, if you're a business that is exposed to flooding, there is something organizations of fund providers do that they call ESG due diligence. So the due diligence is they have a set of criteria, they have a checklist somewhere that they have written a list of their expectations, and they want to see how you perform vis-a-vis those expectations. So where they have identified that this business is prone to flooding and may impact the ability to return that investment. So they want to then be able to see in your books how you are managing that risk. They want to see in your reports. So in an instance where you have not even identified it as a material risk, it then means that you probably don't have strategy around it. You don't have policies guiding it. You don't have it embedded in your day-to-day activities, your emergency response policy, on how you want to manage this when it materializes. That then ranks your risk exposure very high, in the evaluation of that fund provider, and it helps them to make decisions as to if they want to provide the fund to you or not, or the extent to which they want to provide to you. Another example is also an instance where DFIs would so let's say they have $100 million for you, but they see that there are some areas that are still lacking, or even the level of understanding on this risk is still a bit slow within the organization. They then earmark a portion of the amount they want to give to you. They earmark it to capacity building, to say, take this first and go and, expand your capacity in responding to this risk from knowledge perspective, from policy and all of that. When you are done, we'll reevaluate and see if we can give you the rest of the fund. That has also then limited the fund that you have to get, what you need to get done. So, but in a situation where we have proactively identified our risk ourselves and we have evaluated and managed them to a reasonable extent, it then maximizes the opportunity that we have with these various investors.
Well said. Thank you so much, Yewande, for the response. That area, I just want to ask if someone wants to put up their hands so that they are called to speak. And whilst we wait a few minutes to see if we're going to get any more questions, I would want to reiterate that we brought you this webinar because we are celebrating the Internal Audits Month. The month of May has been earmarked for that, and we do that every year as KPMG. As part of our activities, this marks the last engagement we have with the public in terms of our webinars. God willing, on Friday, we're going to have an engagement with a school where we are also trying to be socially responsible, and eventually we'll climax all the activities on Friday. So if you're an internal auditor and you did not consider any activity in this month of May, it's not too late for you to have an engagement with your organization just to make sure that they understand the value the profession brings to the organization. I don't see any question, so I'll go ahead and say a big thank you to Asenso and Yewande for the insights shared on this call. We still have our partner with us, Kwame Saponbani is still with us, so we would ask him to kindly give us the closing remarks, and then we'll call it a day. Kwame, over to you. All right. Okay. So we'll still thank Kwame for being with us for throughout the webinar. And thank you so much for staying with us and your participation. Let us hear from you. Engage with us on our social media handles and let us hear from you how this has also impacted you. Kwame, please, we would want you to give us the closing remarks if you can hear me. Kindly unmute.
Yes. Again, thank you.
Thank you.
And all the facilitators. Wonderful presentation. For all those of you that made time to join, thank you as well. I learned a lot in this interaction, and I hope you did as well. And as Adele said, please do give us some feedback with regards to how well this has supported you in how you're thinking through this process and also how you're doing your work. And thank you all, and enjoy the rest of the day.
Enjoy the rest of your day, as Kwame said. So goodbye.